at 15, if we take my initial target of 10,000 golds, or at 15 ratio, that would mean $666 silver. And might sound like a sensational figure, but I think that's very probable. And that's not even a hyperinflationary figure. And then we have to remember that there's not much silver around, a massive shortage. No, there's no stock of silver.
Ladies and gentlemen, welcome to this special interview. Today we have a returning guest to the show, Egon von Greyerz. Egon is founder and managing partner of Matterhorn Asset Management, located at goldswitzerland.com. Find out more about Matterhorn Asset Management in the description below. Egon, I'd like to welcome you for joining us again on Silver Doctors.
Well, great to be on your show again. So look forward to our chat.
Yes, certainly. Now, Egon, in your most recent article, you have been discussing about the Nixon closing the gold window in 1971. And one of the things that you said was, I believe, not many people knew what was coming. And of course, that was a big change. And a couple of years later, gold was even revalued again to $42 an ounce. Could you explain what you see coming to the US dollar, to the global monetary system, and what that means for gold and silver, Egon?
Yes, Paul. So, yeah, Nixon in 71, nobody had realized what actually was going to happen then. The Chinese published an article about it, which I also have on one of my articles, and they basically said that this is the end of the Western financial system. And of course, they were right, totally right. Gold reflected that in the 70s, as you know, going from $35 to $850, and silver from a few dollars to $50. And of course, debt started to increase exponentially. And initially, of course, in the 70s, on top of that, we had high inflation. I lived in the UK at the time, and we had average maybe 17-18% inflation for 5-7 years. Now, so that started the end of the financial system in the West, and now I think globally also, or this financial system. There'll be another one, but that will be different. And so it's been a long period, of course, gold stopped going up in 1980, and then had a 20-year correction, as we all know. And then it started again in the early 2000s, and that's when we went into gold as a company, helping people to preserve wealth by storing gold and silver outside the banking system. Now, what has happened now lately, and of course, we've seen an explosion of money supply, we've seen an explosion of debt. Debt has trebled since 2000 and doubled since 2006, when the great financial crisis started. And now we are coming to a point now where central banks are absolutely panicking. And the statements that we have seen in July and August, I call that, by central bankers, I call that a seminal event, which means that you can hear how desperate they are. They're all saying, from the Fed to the ECB, of course, Bank of Japan, and even Bank of China, they're all saying, we are going to do what it takes to keep this system going. And as you know, everybody's lowered interest rate to zero, and then negative. We have 17 trillion negative interest rate bonds currently. And so therefore, I've compared this period to the 1971 period. So what happened to me in August? That is now the final phase of this money printing and the desperate attempt to save the system. They managed to kick the can down the road in 2006 to 9. I don't think they will succeed again. They will try with the same methods, but I don't think they will work. First of all, interest rates are already zero or negative, so there's not much room there. The money printing this time, I don't think will have any effect. So the effect on, of course, the currencies will now finish their race to the bottom. Most currencies have gone down 98 to 99% since 1971. when Nixon took off the gold backing of the dollar. And I think those final couple of percent are going to happen in the next, let's say, 5 years. So, but of course, 1 or 2% to go to zero means 100% from here. So we are going to see big falls in currencies. They're all going to fall. They can't all fall against each other at the same rate, so they will take turns. And maybe the dollar is strong for a little while still, not for long, I think. And the dollar will probably then be one of the many that collapses, and maybe the first one, because that's the most indebted country in the world.
That's very interesting that you bring that up, because a lot of people are bringing across the analogy that the dollar is I believe the analogy goes, the cleanest dirty shirt in the laundry baskets. So they're saying that it's going to be the last to fall. So I find that interesting. Do you think that, yesterday on our live stream, we were asked, are we closer to 1 year or are we closer to 5 years? Do you think that this can drag on for many more years, Egon?
Well, it normally doesn't happen overnight. So the scenario I see that interest rates might come down still. America might, and the Fed might try to reduce them. But at some point, I think that the weight of the bond market will mean that investors are going to get out of bonds. And maybe China will also do something to the US bond market, which is in retaliation of this trade war, and dump the bonds. It will hurt them, but their gold position, which is officially around 2,000 tons, is probably maybe 20,000 tons. And I think what they lose on whatever they get rid of in dollar bonds, they will make on the gold. But in any case, long-term investors in long-dated bonds, I think, will start selling at some point, and they will then bonds are going to come down. Now, bonds is the biggest bubble in the world and the biggest problem in the world, so long rates will start going up, and eventually they will pull the short rates up also, because central banks will lose that battle to keep rates low, and then eventually we will have, which I experienced, the high rates of the 1970s. My first mortgage in the UK, for example, was 21% in 1974, I think it was. So can you imagine, Paul, how many people could cope with 21% today? Most people in Europe, where mortgage rates are, you can get a 10-year mortgage for here, or in Switzerland, or in Germany, or many countries, for about 1.25 maybe. And I mean, I know even insurance companies, because when you have negative interest rates, they don't know what to do with their money. So insurance companies are now doing mortgages also. And I know I have a friend, for example, here in Switzerland. He's been offered a 10-year at 0.65%. And of course, we've seen already in Denmark, they're actually offering negative rate on a mortgage, just 0.5%. I think they make it up a bit in fees. So I think that the net effect may be that they pay nothing. But still, I mean, that is just ridiculous. In the end, the bank pays you for borrowing their money. It's crazy. And savers get nothing. There's no incentive to save. And as we know, savings is the only way to, in long term, to invest, not by borrowing, but to actually to invest. Savings, anyone who studied economics knows savings equals investment. But we have no savings today. Therefore, we have no real investment, just investment with borrowed money.
Now, bringing up China with their gold reserves that you just mentioned, we have seen record movement and record purchases by central banks in 2018, and it seems like the trend is going to continue again. We still have a few months to go left in 2019, but obviously they're preparing for something. But what we think is not present yet is the institutional demand and the Western retail investor, so to say. So, you've been through a couple of the cycles here with the commodity cycles. So I would just like to have you, if you could, explain what exactly is gold fever? Will it happen when the institutions come in, or will it happen once the retail investor come in? Or how do you see once all of the aspects start moving into gold beyond just sovereign nations adding to their reserves?
So Paul, this obviously it was all over the papers that central banks have increased their gold holdings, but that's correct in total. But what they're not pointing out is that there were virtually no Western central banks increasing their gold reserves, except for a little bit in Poland, a little bit in Hungary, but that was nothing. So the big increase is, of course, China, Russia, Turkey, etc., India a little bit. So in the West, of course, nobody understands gold, and nobody buys gold, and including the central banks, who, of course, in the last 20, 30 years got rid of their gold holding. But still, yes, overall central banks increased, but as I said, the reporting of that was not particularly accurate, as I said, because it's not in the West. Nevertheless, yes, gold buying is gradually increasing. There's no gold rush yet. And I reported recently that the Swiss gold refiners, which are the biggest in the world and refine about 70% of all the gold bars in the world, they actually have quite good stocks, unusually higher stocks. So the rise we've seen in the gold price until now has taken place mainly in the paper market. So just as the fall always takes place in the paper market, because there's very little selling when gold goes down in physical gold, and the same is happening. The first move is always in the paper market. So that's not unusual, and I just think that will basically make the problem bigger when gold really takes off, which it is on the way of doing now. So and when it does, I think all of those paper shorts will, of course, rush to cover, and gold will spike up then. We will see that. Maybe he'll come back to that later. But coming back to institutional, there's less than 0.5% of investment gold. Less than 0.5% of world financial assets are in investment gold or in gold. And therefore, institutions have virtually nothing today, because they don't understand gold, and they don't see the purpose of it. And of course, they have made so much money out of these inflated asset markets, which I call the bubble markets, the stock market, the bond market, and the property market. Now, that's coming to an end now. Those bubbles are all going to pop in the next few years. I think they will start very soon, actually. And institutions will start now seeing that it will be necessary to own some gold, own some hard assets, and to hedge themselves against, which is going to come later, inflation also. And when we're actually starting to talk to institutions now, that they haven't been interested so far, but I think that is going to change, and I think there will be a big investment group coming into gold. Now the market is so small, and institutions, if they put 1% of their assets into gold, even the gold market couldn't take it, but it can take it in one way. It cannot take it at $1,500 or $1,600. But let's say that an institution wants to put $1 billion into gold. So today, they wouldn't. If everybody did that, there wouldn't be enough gold. But instead of putting $1 billion into gold at $1,500, they're going to get the price will be 15,000 instead, and they will get a tenth instead. But they will still put their $1 billion into the. So the demand from the institutions will be satisfied not by the quantity of gold at these prices, but at much higher prices, and that's why gold is going to increase in price, and B, gold is going to then be priced in a way that more institutions can buy it. But it will be a very tight market, and there's no way they can put major amounts into gold. But even whatever they put, even if they put, as I said, less than 0.5% or 1% of their assets, that would be that would make the gold market really, really go very high. And that's, you're right, it's going to come. But even, as you know, even private individuals, of course, we deal with high net worth, mainly high net worth and ultra high net worth individuals who want to store their gold outside the banking system. And of course, there we've seen a steady demand for the last almost 20 years now. Which is unaffected by downturn in the gold price and the stock market moves, etc. And these people don't sell; they hold gold for the long term, which we, of course, think is the right thing to do. We are into gold as an asset class just to protect investors' assets. It's an insurance. We call it life insurance because we think that the wealth destruction in the world is going to be massive, and therefore you need to have some gold as insurance, whatever percentage you have. Some of our clients have a very high percentage. Many of them have 20% or more, 25% or more of their financial assets into gold. So we're going to see a major change in that market, and there will be times of shortages of gold, definitely.
Now, last week, gold hit record highs in the euro. We see gold at record highs in many other currencies. You had been writing about the Maginot Line at 1350, and 2018 we couldn't get above it. Basically, ever since Brexit in 2016, it's been hard to get above those levels, but we have since broken out and we shot up an additional $200. What are you looking at right now for your outlook for gold? And this is not even considering the possibility of a reset. This is just your natural outlook for the yellow metal at this point. What are you looking at from here, Egon?
Paul, so as you pointed out, I was in February, I think I wrote an article about what I call the Maginot Line. Maginot was the defense minister of France in the 1930s, and he built this defense line, a very strong fortification line against Germany for an attack by the Germans. And it was very sophisticated with underground cities and railways, etc. Of course, they were unfortunate that the Germans came around the corner instead and came in through it via Belgium. So it didn't work. All of this money, sadly, didn't work. But nevertheless, it was for a long time a very strong line of defense, and this is why I call the 1350 level, which has been resistance for gold since 2013, and therefore I call that the Maginot Line. But I said also we are going to break that in the next 3-4 months. I said in February, and we broke it in June. But that was clear to me. There was now enough energy built up in this line. Fundamentally, we'd always have to break it, and all other currencies were breaking the similar type of level. So just that the dollar was a bit stronger, so it hadn't broken in dollars. So it had to happen, and it did happen. Now, to talk about projections and price targets, to me, price target at a certain point is not that important. Gold is wealth preservation. Gold is money. And really, gold should not be valued in worthless currencies, whether it's euros or dollars, which are falling in value every day, because gold mainly reflects the debasement of the currencies. Nevertheless, but nobody likes if I say, well, it's really a kilo of gold or 10 kilos of gold or 1,000 ounces or a few thousand ounces of gold. That's how you should measure gold, because nobody understands what that means. So therefore, everybody likes to relate it to a price. So just to do that, I did say at the time when I said after we break through 1350, I think we're going to go quickly to 1650, maybe 1700, and I think we're going to do that pretty soon. I mean, there'll be maybe a little correction even now. That's possible, but the uptrend that started in around 2000. And that paused in 2011 has now resumed again, and that's going to be a strong uptrend. So obviously, gold in dollars is pretty soon. I don't know if it's going to be this year. I wouldn't be surprised at all. But the gold in dollars is going to break 1920, which was $1,920, which was the high in 2011. So that we're going to see, but that's just a temporary. Well, there's not even a strong resistance in my view. Not going to hold long that level for a few days maybe, because as you pointed out, the gold has broken the 2011 peaks in most currencies. So therefore that will be an easy one to overcome in dollars also. And whether it happens later this year or early next year, I don't know, but it's going to happen. And then gold is going to rise a lot faster, and we're going to see levels. I've had for the last 15, 20 years, I've had 10,000. It's a bit of an arbitrary figure, but I think 10,000 in more or less today's purchasing power is possible. And we will probably go higher than that even in today's purchasing power. And then, of course, when we get to, which I believe we will do, when we get to hyperinflation, then of course you can add many zeros to it, which is meaningless. But gold really does is to preserve purchasing power, and that's what it's going to do when all the currencies now are going to lose all their purchasing power in the coming years. And that's why it's so important to hold gold, because previously stock markets, bond markets, and property markets reflected this destruction of money because of the money printing and debt. But I think that run is now finished. Those are now the bubble markets. I think they are now turning down. So you're going to see stocks coming down, bonds coming down, property coming down, as I said, and gold and silver going up, and the other metals.
A couple more questions, Egon. I'd like to get to silver in a minute, but you just mentioned hyperinflation. And for some reason, there's still a debate going on about whether we're going to have a deflationary crash, whether we're going to have a hyperinflation. And to me, fiat currencies always go the route of hyperinflation because that seems the path of less resistance that governments are always choosing on a fiat currency system. Could you explain a little bit more about the hyperinflation that you see coming and how you might see that playing out, Egon?
Yes, Paul. So, of course, to some extent, we're going to have different inflations. We're going to have deflation and inflation, eventually hyperinflation at the same time, because the bubble assets, as I call them, are going to go down, so they will deflate. And whilst hard assets will inflate, food will also inflate, in my view. So there'll be deflation and inflation at the same time. But the one that all the people would notice is that the value of property is going to crash, the value of the stocks are going to crash, and the value of their bonds, if they hold any, are going to crash. So that's the deflationary part. But also food and hard assets are going to go up in price. And then, of course, governments will contribute to this hyperinflation by the massive money printing that is coming in the next few years here. And therefore, that eventually will create, in my view, hyperinflation this time all over the world, because it's not just one country, one region. China has the same problem, Japan has the same problem, emerging markets, the West, of course. So it will be everywhere. So, but at some point, then, the scenario I see, at some point, then interest rates will go high, and we will have high inflation, hyperinflation. But then at some point, that will have no effect, and it's not going to save the banking system, and it's not going to save people from their debt. And then I think we will have an implosion of assets values. Implosion of credit, of bonds, and implosion of all these other bubble assets that they've already gone down some, but they will go down a lot more, and that will be the horrible, and of course that will mean that the banking system will not survive in its present form, because this debt, which I call about 250 trillion debt today worldwide, and you add contingent liabilities around the world, pension funds and medical, etc., maybe say another 250 trillion, and then you add derivatives, which I estimate at least 1.5 quadrillion, because the BIS, Bank of International Settlement, they reduced the figure a few years ago from 1.5 to about 600 trillion. I don't think that's a real figure. I think that we're still at over 1 quadrillion. So let's say 1.5 quadrillion derivatives, and then half a 500 trillion of debt and unfunded liabilities. So you're over 2 quadrillion of debt. The biggest, obviously, among those, or debt, or if you want, risk, because derivatives is not straight debt, but it will become debt, because that was going to be a big disaster. Derivatives work on the way up when there's liquidity. They're not going to work on the way down. And when counterparty fails, that system will fail. So that's going to be a big problem, and therefore we are going to have massive money printing. And then, as I said, yes, the system needs to be restructured, but before that, there will be massive implosion of assets, and of course, gold and silver will reflect that. So therefore they will at least maintain purchasing power and probably do more than that, whilst most of the world is going to lose money. So this will be a horrible period for us, for our children, grandchildren, etc. Life is going to be very different. I always say, though, that take whatever measures you can, protect yourself. Then what is important in life is family, a few friends, having values, helping each other, but live your life and enjoy what you have for the time being, because and protect yourself, but don't go and be depressed. It will be a lot harder when you've had an easy time. I've lived since after the war and had a good time, but the next generation or the young generation today is going to have some hard years. It'll be transitional. The world has so far always survived. And then when we need this forest fire to get rid of all the debt, to get rid of all the bubble assets, because the world can only continue to grow from no debt or very little debt. There's no chance that the world can continue at these levels. So therefore, we need to cleanse the whole system. So that's a good thing. But when it happens for a period, however long that will take, yes, people will suffer, definitely, sadly.
Yes, and I think I just wrote down, that's why I believe you've been talking about the next 5 years are going to be more about survival than anything else. Is that correct, Egon?
Well, I think the next 5 years, as I see it, will be when all of this takes place in markets, and maybe markets reach a bottom around 2025. Let's say that. But that doesn't mean that the economy reaches a bottom, because it doesn't mean that the economy turns up, because then we have got rid of so many assets. There's been so much wealth destruction, which means that also companies and industries, etc., are going to suffer. So therefore, although markets might bottom, economy could take a lot longer before it bottoms, or it might reach near bottom, but then it's going to go along the bottom for a very long time. So that could take another 10 years or longer. Yeah, nobody knows. The historians will write about this afterwards.
Now, switching to silver, you have recently written in one of your recent publications that people will be amazed at the speed of which silver is going to move in its dollar price. And since May 28th, silver is up 35% in dollar terms. My point there is a lot of the technical analysts keep, with every dollar increment, are saying, oh, this is it, we're going to have a massive correction. This is it, we're going to have a massive correction. But silver has moved very quickly over the past month. My question to you is, how do you think about silver? Because, the ultra high net worth clients obviously are going to be putting a lot into gold, just because, I look at silver as like a 22 caliber rifle round, whereas gold would be like a 50 caliber rifle round. But my question is, what is your outlook for silver? How do you think about silver, and any thoughts on the gold to silver ratio there, Egon?
Yes, absolutely, Paul. For very long, so we started with gold for ourselves and for some of our friends. It wasn't even open to the public. But we started in 2002. On a bigger level, and then 2005-06 we opened it up we became a regulated company in Switzerland and opened up for outside investors. And at that point, I told people that if you don't absolutely specifically want silver, I would suggest only gold, because gold is a much safer and stable currency. Gold has been money for longer. And then also in Europe, you have the advantage of gold is actually a VAT, value added, tax free, so which silver isn't. And also, as I say, silver is not for widows and orphans because of the volatility. You had, as I said, from early 2000s, silver was a couple of dollars. Then it went up to $20, $21 in 2008, and then went back down to $7, $8, and then 2011 up to $50, and then down to $13 just recently, a year or so ago. So that's massive volatility. So silver moves twice as fast, at least, as gold, sometimes 3 times as fast, because 2011, the gold-silver ratio, which is gold divided by silver price, it reached 30 at that time. It'd been up to the mid-80s, and it reached 30. Now, and now we've seen recently this year we see 93. So it's gone from 30 to 93. That means that silver has gone down 3 times as fast as gold, basically. And that's why I told clients don't own silver. But now I think that we recommend roughly 20% maximum in silver, physical. I'm talking about only physical here. 20% in silver and 80% in gold. If they want some silver, I think that's not higher than that, because they will love it on the way up. And we are going to see the way up now, but they will sleep badly on the way down. And this is why I think if you're a nervous investor, you shouldn't own silver. But if you're happy with that volatility and if you're not too exposed, yes, own some silver, because now we've seen the ratio. I've been forecasting this for a while, that the ratio would crack. And then, so we've gone from almost 94, we adjusted down under 80 now in a very short period of time. And that's just the beginning of that gold-silver ratio fall. So gold-silver ratio coming down, for the investors who don't understand that, means that silver going up faster than gold. And now we're going to see the next phase. So this is going to continue to fall sharply and relatively quickly, I think. And I would say the first real support will be the 30 level in 2011. So it might bounce there. Well, obviously it's going to bounce on the way and it'll be volatile. So I'm not saying that there will be lots of consolidations on the way, but nevertheless, that's an important support, and they might stop longer at 30 level. But the long-term historical average is around 15 in the gold-silver ratio, very long-term historical. So and it's not impossible that overshoots, so maybe gold goes to the silver ratio goes to 10 or so. But at 15, if we take my initial target of 10,000 gold, so at 15 ratio, that would mean $666 silver. And might sound like a sensational figure, but I think that's very probable. And that's not even a hyperinflationary figure. And then we have to remember that there's not much silver around, a massive shortage. No, there's no stock of silver around in the world at all. Most silver is on industrial or a bit of jewelry, and only about 30% or so is investment silver. So I think that now it's right to be exposed to some silver, but as I said, because of the volatility, we recommend certainly to people not to put all your money into silver, because then are you going to see the massive roller coaster then, which if you have strong nerves, might be all right, but I think it's safer to have more gold than silver.
And final question for you, Egon. There's so much going on in the world right now. We have Brexit and all the uncertainty surrounding that. The vote took place in 2016. Now we're talking about October, and now there's even more uncertainty this week. We have the 2020 election, and that's just turning out to be a circus sideshow, in my opinion. There's geopolitical problems between Hong Kong and China. We have the Middle East that's still, Turkey's threatening to send refugees to Europe again. There's problems in, with Iran, the Strait of Hormuz. So my question to you is, what have you been focusing on when you're thinking about the economy and the markets? What have you been looking at? What will you be following? What will you be paying more attention to going forward as we wind down 2019 here, Egon?
Yes, well, no, you mentioned a few of the problem areas. I mean, they are actually unlimited, these problem areas in the world. There are so many. These are symptoms. Brexit is a symptom, and it's getting messier by the day. The US election, if the stock market comes down the next year, that I think is very likely. It's always been very hard for a US president to be re-elected if the stock market is really down. So that will be a mess too. But these, to me, these what I call events, they're really sideshows. They're sideshows to a world which is rotten to the core financially. And that is the debt levels that is making this world rotten. So all of these things that you mentioned and many more, where there are conflicts in the Far East, the Middle East, or whatever, trade wars, etc., I call them catalysts or triggers. One of these things will flare up, and then markets will fall faster, or start falling rapidly. So they are not the cause of the problems we are going to see. They are just the trigger. The causes we already have in the debt and in the bubbles of stock markets, bond markets, and property markets, etc. So that's already there. So that as far as I'm concerned, I haven't changed my mind for years and years on this. It's only a question of, it's taken a bit longer than I expected this, because the central banks did a good job from their point of view in delaying the inevitable. But we are there now. So what the trigger will be for this debt collapse, because it's the debt collapse and the derivatives collapse, that's going to pull the world down. Not the event is just what the papers will write about and blame, but it will have nothing to do with that event whatsoever. What's going to happen to markets? So I'm really focusing, obviously following everything, but to me it doesn't really matter what the trigger is, because I know there will be an event that triggers it, but that's not the reason. The reason is already there. That's why, sadly, the world can't do anything about it. We've gone much too far in these excesses that we have in the world, and they will have to be corrected, and that's coming next.
Egon von Greyerz, thank you for joining us again today on Silver Doctors.
Well, great pleasure to speak to you. I enjoy it very much. Thank you.
Jerome Powell is going to be in your neighborhood in Zurich tomorrow giving a speech, and I believe it's called Economic Outlook and Monetary Policy, or something like that. Now, we know they're not going to allow questions about gold, but if you could sneak in for us tomorrow, Egon, and ask Jerome Powell one question, what would that one question be?
You know what? I think first of all, central banks shouldn't exist. And therefore not central bankers either. And I think central bankers are puppets to a system that is being controlled by if you want to say the elite, or big pharma, big defense industry, oil industry, etc. And the big investment banks. I mean, the investment banks are telling the Fed what to do, not the other way around. I mean, the Fed runs to the investment banks and asks, Goldman Sachs, JP Morgan said, what should we do? That's why, that's why they were saved 2008, because the Fed was told to save them. Otherwise, they would have lost too much money and too much bonuses, these guys. So therefore, I'm sorry to disappoint you, but I don't really, because whatever he says, he's not going to tell me the truth. He's going to lie, or he's going to avoid the question. Central bankers, the day they become a banker, they put a politician's hat on and they become liars, or definitely not ever being able to tell the truth. I mean, we see this with Greenspan. For decades, he talked about gold, that gold was the only thing that could save the system, etc. The day he became a central banker, he couldn't ever talk about it, and now he talks about it again all the time. So, and in the meantime, he forgot about gold, and therefore, so I mean, we totally, absolutely waste of time to ask Powell about gold, because this would be like Bernanke, I mean, it would be some idiotic reply. I'm sorry to say. I'm sure he's a nice man. I don't know him, and I don't mean to be personal at all, but I'm just saying, with wearing the central banker's hat, they will never tell you anything of interest. So therefore, I'm not going to go see him, and because he wouldn't tell me anything that is of any interest to me.
I share your views, right? I think the Fed should be abolished, right? I think that power should go back into Congress, coin money, and all this and that, like the Ron Paul school of thought.
Yeah,
I'm silver boat first.
I hope you got some silver then.
Yeah. Oh yeah. See, you're 80-20 gold. I'm 80-20 silver, but
No, but if you are, I mean, if you know the stuff and follow it all the time, it's different. But you know, if you are just an amateur investor, then that's why I think you want to be able to sleep at night. But if you're in control, like you are following it, it's different.
it is a roller coaster.